And if you're comfortable with 75,000, cool. If you're comfortable with 250, cool. You're just, you're a different type of investors. And then that gives you a sense of they would invest around that much, right? And then you can start to ask them, later on, you might not want to ask them right away, but you start to ask them, are they liquid? How soon could they invest? Like I have some deals coming up. Like, are you able to invest? Like if I bring it up to you next month, and that'll give you an idea of their liquidity, right? They might say, no, I have to 1031 something. I have to sell.
Welcome to the Real Estate Mindset Podcast, hosted by Eric Nelson and brought to you by Wild Oak Capital. Eric is a real estate investor, business owner, and performance coach. Throughout this series, Eric explores the mindset behind why certain investors are so successful and how we can learn from their achievements and failures. Eric asks the tough questions around the habits, discipline, mindset, and more required to achieve the most ambitious goals. Thank you for being here and enjoy the show.
Hey everybody, welcome to the Real Estate Mindset Podcast. This is your host, Eric Nelson, and today I have a guest it's been elusive for good reason, but it's a long time coming. So Powell Chee, thank you so much for coming. I'm so glad we made it happen. Thanks for being here.
Hey, I appreciate it, Eric. And I am sorry that I wasn't able to do it right away. I did want to do it right away, but there's a couple things coming up, and I was like, Eric, can we just postpone this for a little bit? I think it'll be worth it. But if we could just postpone it, so I'm glad to be here and make this happen for sure.
No, I had to tease you a little bit because you had significantly more important stuff coming up. Had a baby recently. We were talking in the pre-show, 4 months old. I mean, it's incredible. So biggest congrats in the world, man. You're a father. It's like it's like a tribe that you're involved with now, and it's super cool. So no worries at all, of course. So let's jump right in, pal. What I always do is ask the guest to give us a background. I mean, where are you from? What started in your real estate? I know your background, but what got you to multifamily and then most recently self-storage? So if you kind of give us the run through.
Sure. So my name is Powell Chee. I live in Los Angeles and spent most of my time really here in California, although I did live in the Midwest for a little bit. But started getting into real estate investing in 2015 was when I bought my first house. So that was a house that I bought in Kansas City. Still live in LA. So I live in LA, bought in Kansas City, single family house rental. That was my first kind of foray into real estate investing. Although I did some things with my family previous to that. Private lending type of things, but actually my first property that I bought, 2015. From there, I thought, hey, this is great. This house is working out great, but I realized really quickly it's not scalable the way that I was doing it. I mean, just crazy stories and everything, but it was like, hey, I'm not going to be able to repeat this process. I pretty much just kind of got lucky, and I just knew that I was not going to be able to just do this, like 2 or 3, 4 times a year, or 5, 6, 7 times a year, which is what the original plan was, right? So I said, hey, what can I do? How can I scale this up faster and make this certainly something that's a little bit more skill involved and a little more repeatable and more scalable, not just, hey, I got lucky, right? And so that led me to going into multifamily and going up larger into multifamily. And so about a year later, after buying my first single family house, I bought an apartment building in Indianapolis. Again, still live in LA, bought it out of state. That was a big jump for me. So just kind of in general, buying something out of state was a big jump. And that was a big epiphany that I had from seeing other people that had done it. And I thought, wow, this is great. I don't have to buy in LA, or I don't have to buy something over here, which I found very, very difficult and almost too high of a barrier for me to really enter over here. And then from buying my first, single family house, then bought an apartment building in Indianapolis. It took me about a year later, I bought another apartment building. And then about a year later after that, I got involved in 5 different syndications, which are, larger partnerships on apartment buildings. And these were all apartment buildings that were over 100 units each, over $12 million each. Certainly not something that I was doing by myself, but I was doing with a team of people. But I was scaling up a lot faster and was able to do 5 different syndications on the general partnership side, all in 1 year. And if I just kind of fast forward a little bit, then COVID kind of hit, right? And then when COVID hit, the way that my business model was working was, hey, I was buying in apartment buildings all over the place. So I mentioned Indianapolis. I had a single family house in Kansas City. I had Dallas, San Antonio, Jacksonville, Phoenix. There's a couple of Atlanta, other ones like that. And so I thought, I'm not an expert in necessarily one of these markets, right? I'm not one of those people. I'm more of like a shotgun approach that I am looking all over the United States, right? Because I figure the whole United States is my backyard, since I'm not going to look in my actual backyard anyway. So let me look at the whole United States. But not being an expert in the area really, I felt, prevented me from really taking advantage during COVID of scooping up something that is a great deal that was going to happen during COVID. So I said, I'm not going to buy anything I know for at least 6 months, because the market is pretty crazy now. There's eviction moratoriums going on, and I don't know about canceling rent and all kinds of delinquencies and what's going to happen with all this COVID. So I said, I'm not going to buy any multifamily for 6 months. So what should I do then? Well, I'll spend the time looking at at the time was my second favorite asset class, and said, hey, let's look at self-storage. And previously had spent maybe 5% of my time on self-storage, so I didn't really know how to evaluate it at all. Spent a lot of time figuring that out. And then more recently was able to close on a self-storage deal in January. I closed on my first, and then more recently I closed on a few more. And so I guess that's my background as far as bringing you back up to speed. I don't know if that wasn't quite 30 seconds or anything, but yeah.
No, there's no time limit here, man.
Yeah.
I'll talk to you for hours.
Sure.
No, I mean, there's a lot to kind of unpack there. So first of all, like, it's so funny. It's a classic story, right? I mean, it's the buy the single family out of state, because I have a similar market where I live. Things don't cash flow. And so you got to really find the gem. So I actually did buy in my backyard. But the smarter play would have been to do what you did. So to buy out of state. But all that to be said is, a lot of times you hear this, okay, I bought one or two single families or a duplex or whatever, and I had this plan to buy one per year for like the next 20 years. This is like my initial plan. But then pretty soon you're like, well, that's really hard to do, and it's going to take 20 years. So then lots of people say, okay, how can I scale? So it's interesting to hear that story again. And I do know, I mean, I heard this on another podcast. Sounds like you bought your first multifamily asset either with a small partnership or your own money before you jumped to syndication. And I think that's pretty cool because, well, I guess I'll ask the question, is that true? And then what did you learn from it? And then I'll give you my opinion of it.
Yeah, so it was. And the first one was really my own money, right? And so just buying it by myself, because I said, at this point in my real estate investing career, I was like, hey, I really love what I'm doing, but I don't know that necessarily I'm good at it. I don't know that necessarily I know exactly what I'm doing. I feel like I've done a lot of the research and I've been doing it, but there's a difference between I'm feeling like it versus I'm proving it, right? And so I said, I don't want to really mess with anybody's money at that point. I'm going to buy my first one by myself. If it goes great, hey, awesome. Maybe I'll get other investors later on, which is what happened. But if it's something that I don't want to get into in the future, and I feel like, hey, this is just something I want to try myself, but it didn't pan out, well, then that's just my money, so I don't have to worry about it, right? So yes, it was my first deal, did it by myself. The second deal was with a small group of partners, right? Just family and friends, people that had kind of been following me as my path. And then as I started getting more of the syndications, it was more like, hey, my network is a lot larger now. People sort of know what I'm doing. And I have other people that want to join me in on the projects that I'm working on, right? So
I think it's cool. So I think I want to just say, I think that's really cool that you took the time to invest your own money. To be like, okay, I want to try this, take the risk, learn it. Maybe you hate it, or maybe you're not a good operator. I mean, you just never know, right? So it's pretty cool to do that. I mean, to jump into however it might be 6-plex, 8-plex. Sounds like in your case a 40-plex, but just try it, before you start doing the syndication thing. And personally, that's what I think is the best model. So I guess I want to commend you. It's a big jump from single to 40 units. So that's pretty cool. But then to move to syndication, and then, I guess we'll just jump right to self-storage, and we can come back to multifamily later. But it sounded like you were like, okay, I'm gonna put the multifamily thing on pause. COVID, there was just a ton of unknowns, right? And like you said, there might be a deal out there, but you really have to know the market, or maybe you really have to have a good like broker relationship or whatever it might be. So then why did you find self-storage to be safer or an avenue to travel down during that time? I mean, do you find it to be safer during that particular time?
Yeah, specifically what brought me to storage, right, is that the idea is that when you looked at the last downturn, so not necessarily like recently in COVID, because there wasn't enough data and nobody really knew what was going to happen with that. But when you looked at the last downturn, you looked at storage compared to all the other asset classes, all the other real estate classes, and all the other asset classes. Now, storage has come out as one of the most stable of those asset classes. Like it lost either the least or it gained even up in the most. I wouldn't say it gained the most, but it gained very high. It was very high in there. So it's relatively really stable compared to retail, compared to multifamily, compared to office space, compared to a lot of things. I've heard even that it did the best in the Great Recession. The only thing that actually did better than it was the alcohol industry, right? And so
no,
like, well,
no surprise there, I would say.
Yeah. And so, and I don't know if that's true or not. That's just what I heard, but I mean, I guess it makes sense to me. Like I would believe it. And so, just knowing that the stability of it, right? And then you just kind of figuring out, okay, well, what are, just in general, what are the things that attract people to storage, or what are the differences between storage and say multifamily? That's right. I mean, the first thing is that the expenses are a lot lower, right? You don't have, in a typical one, you don't have a lot of plumbing, or you may not even have any plumbing. You may not have a lot of electrical, electricity, and you may have none electricity, right? And your payroll costs can be significantly lower. Your turnover costs, like in multifamily and in residential, every time you turn over a unit, the person's been there for, say they've been there for 8 months and they break their lease. Well, you still got to probably paint the unit, right? You still got to probably maybe replace the carpet or some section of the carpet or some type of flooring. I mean, you're basically out minimum $400, $500, right? Just for the cleaning, potentially carpet, painting, whatever, something like that is minimum like $500, right? And it takes a minimum, I don't know, 2 weeks. Everybody says we can do it in 7 days, but it never really turns out that way. It's like, 2 weeks, 3 weeks before you can actually get it listed and that kind of thing, right? Storage is like, okay, you lift up the door, and then if there's nothing in there, you just take a broom and you sweep it out, right? Or you just grab the stuff in there, or if you've already auctioned it, you auctioned it. But assuming there's nothing in there, you just basically go in there and you just sweep it out and you shut the door and put a lock on it. And you say, okay, it's ready to rent, right? And there's no painting, there's no nothing like that. So the turnover cost significantly lower and a lot faster. So there are a lot of advantages with that, right? And so those are the kind of things that I thought, well, also with the eviction moratoriums going on, eviction laws are different than lien laws. And storage, you're using under lien laws, and which are in a sense kind of protecting or having protections over people's stuff. Eviction laws are protecting people from getting thrown out on the street, right? There's a lot more sympathy for people getting thrown out on the street versus, hey, your stuff is in somebody's place and you're not paying for it. Like, they're going to get rid of it. People are like, sounds pretty legit to me. I mean, yeah, I don't say that like, yeah, you have to keep it there, but I don't pay for it, right? So it just, in general, the laws are a lot more favorable to an owner of storage units versus an owner of an apartment building or a residential unit. So a lot of those things is what really attracted me to storage, right? And so yeah, I guess that's where I started. Right?
Yeah, I guess let's dive in a little if you don't mind. So I guess you might have this question quite a bit. So depending on where you buy multifamily in the United States, a kind of rule of thumb, a loose rule of thumb is you're going to have 50% expense ratio. So let's say you make $100,000 a year, it's going to cost you $50,000 to run that property. It's kind of a loose ratio. What is kind of the ratio for storage?
Yeah, and I use that too in multifamily as well. But you use general rule of thumb, 50%. You just kind of take 50% of your gross revenue is going to go towards expenses. Well, in storage, really that same sort of loose rule of thumb is 40%. So you're going to say 40% of your total revenue coming in is going to go towards expenses, right? So that's 10% extra buffer that you get in storage. Now, the thing about it storage, and I wouldn't say is clear in multifamily. It's like in multifamily, when I look at a property and I start to say, well, I'm going to run this property at 42% expense ratio or 41% expense ratio, you get a little like, I don't know, that's really thin. I mean, yes, that can happen for sure. People do that, but you know that that's like you're running it really well. You got a really nice property. It takes a certain type of property to run at that. In
Yeah,
storage,
or you're not fixing anything. One of those two scenarios.
You have no staff. You're basically that. But in storage, like you can cut your expenses from 40 down to the low 30s. It's fairly common. Like it's not like something where like, oh, you had to have this certain thing and you had to be in a certain market and you had to do certain things. It's like, that happens pretty often that, people cut their expenses down to the low 30s. I mean, truthfully, I've talked to some big operators and I asked them, and these are like specific, like maybe these are special type of units that were kind of in expensive areas, but they're like, we're running to like the 28 percentile. And I was like, that's like crazy. But I wouldn't say that everybody, you should, underwrite at 28% because that's not going to be realistic. But I mean, if you look at 40 and you choose a 40 as a percent as a rule of thumb, I would say that's a good place to start. But you can certainly even cut expenses down even farther than that for sure.
Okay, well, let's continue to walk down this. So for me, this is kind of my personal view on multifamily. So I'll look at a deal, broker sends it to us. We look at it, we get some kind of, it's weird. The market sometimes doesn't have a price. You have to get pricing. It's super annoying. And then, you do underwriting, say, here's where we are, here's where we land, reach out to property manager, say, here's our assumptions. Can you agree? And then we move on to LOI. And that's kind of our personal take on it. And, the question I'm getting to is it similar where the brokers kind of have the deals? And I know that you can source off market stuff, but is it kind of a similar world? And then the second part of that would be like property management. Are there management companies specific to storage? And is that who you're kind of reaching out to second check your underwriting?
Mm-hmm. Yeah. So the answer to your first question is in terms of like, is it a similar world? I would say yes, it is a similar world in the broker sense. Like, yes, brokers have listings. They have offering memorandums. They have listings on their websites. You can reach out to them. They'll give you the offering memorandum. You can sometimes have a price, sometimes not, and then you go through the whole process, just like you mentioned, of doing your own underwriting. I would say though, in storage, there is a lot more off-market deal potential than there is, I think, in multifamily. Now, this is just my opinion, but there's a lot of self-storage people that are just like, I do not work with brokers at all. And they are getting self-storage deals and they're not always just the small ones. Some of them are fairly large and some of them are gigantic, but so there's just, in general, I think what people say, I think if they did the statistics for something like, I think it's 70% of all self-storage facilities in the United States are owned by, say, a mom and pop owner, somebody that owns like one to five properties, right? And then 30% are owned more institutional, like the big REITs or private equity or just larger, professional companies that have done that. In multifamily, once you get about over the, say, 80 unit mark, right? Maybe 100 unit mark, that is flipped. I mean, that's like, you're sort of in the 90 percentile that all these units that are 100 units and above are owned by professional private equity, REITs, those are owned by them, not necessarily a mom and pop owner who just happened to own a 140 unit building. I mean, does it happen? Yes, but just not as much. It's just a significantly higher percentage are owned by professional groups. So that means in storage, there's just a lot more opportunity for that off-market potential in direct to seller opportunity. Now, I don't do that at this point right now. It is something that I'm looking at in the future of like, hey, this is an opportunity that I really should be taking advantage of. I just have come from multifamily background where if I'm going to get an apartment, I'm probably going to syndicate it, and I'm probably going to have to go through a broker. So I've just continued to use brokers as my source of deal flow.
The thing about that, I guess, from what I'm hearing is it's a similar world, right? So you're reaching out to brokers, and then finding the deal. For me, the frustration has always been, finding a deal that works. Have you found that there's more deals that work, or is it kind of a similar scenario? I mean, again, our group will underwrite a lot of deals, and most of them don't pencil for us to at least syndicate the deal. And are you seeing that similar scenario, or do more storage facilities pencil?
I wouldn't say that necessarily more of them pencil out. Well, I would say this. I'm finding that they pencil out better. Not necessarily that there's more of them, that hey, there's significantly more deals to be done, but that when they pencil out, they're not going to pencil out at kind of a top of, hey, the best case scenario is we make our max rate of rents, and we do everything as best as possible, and the market holds up as well, and we're going to get 16% IRR. I'm like, that doesn't sound all that great to me. So to me, the deals that I'm looking at, if the deal like is going to meet sort of like that to me is kind of like a base hit, like a single, right? I'm finding that there are home run deals in self-storage, right? And a lot more of them is what I see. And the way I classify a home run deal is something that I'm going to be able to comfortably say I can project that in my underwriting, we can refinance this property in 3 to 4 years and return 100% of my investor's capital, right? That to me is a home run deal, right? And so I'm finding that there are, in order to do that, your deal has to have enough meat on the bone, right? There has to be enough value add. It can't be like, hey, we're gonna renovate each unit for $8,000 and we're gonna increase the rent by $100, and we're gonna do that over like 120 units. That's not going to get you to in 3 years to be able to refinance your property and return 100% of your investor's capital. You'd return like 50% of your investor's capital at that point. So to me, it's like these home run deals I'm finding in self-storage, and I'm finding more of them. And so that's why that's what I really like. I like that, and I can comfortably say that, like, yes, I can see that we can get deals that like that that are not just base hits, that are not just singles, that are not just like 15% IRR. And that's it. And that's pretty much what you're going to be able to get. There's no real like, unless all of a sudden the market takes off in a crazy way, something that you can't project. But if you're just looking at your numbers that you're underwriting conservatively, that you would say like it's not really going to get much more than 15, 16% IRR, right? So.
Awesome. So I actually like circling back to what we talked about before. I think the question I had was property managers. So are there property managers specific to this, and what does that look like? Because, for me, I've been to facilities where you're like punching a number, there's lights, there's not necessarily even a person there, but I assume you want to have a manager on site or at least local. Is it easy to find the property managers to manage these?
Yeah, so that's a great question. And the property management part is huge. Multifamily, whether it's multifamily or storage, and that's a huge important piece, right? And for this piece, like, to answer your question, first of all, yes, there are property managers that do specifically self-storage, right? And that's all they do is self-storage. Now, you can start at the very, very top, which is a different thing than in multifamily. And what I mean by this is that when you look at who are the big self-storage operators, there's basically like 5 or 6. They're the REITs, they're the real estate investment trusts. So you're talking Public Storage, Extra Space, CubeSmart, Life Storage. Those are the ones that have hundreds of all over the United States, the big ones, right? You can actually reach out to them and they will manage your property for you, right? The professionals, the top people in the industry will manage your facility for you. Now, they're not going to manage a tiny little one. It has to meet their requirements, right? They also have other certain like financial requirements. It has to meet like you have to be able to pay for enough advertising or things like that. They have certain requirements that they have, but they do offer property management services, right? And so you could have your own big giant facility, nice, brand new and everything. And then Extra Space comes in and they run it for you. And it's branded as Extra Space. And it's like, it looks like, you're part of this big giant corporation, right? This big giant REIT but it's yours. So that's a little different than multifamily, right? You don't necessarily contact the big giant operators and have them, manage your facility. So that all said, that can be done, right? Now, the other thing is in self-storage, there's a little bit of I would say deciding whether or not a property needs to be ran, as in you need to have your property management on site or not, right? Do you need to have your property management on site? And in my case, my strategy is, the answer is no. I do not have anybody in the office in my self-storage facility. Mine is all run unmanned. Now, unmanned as much as possible, right? It doesn't mean it's completely unmanned, but unmanned as in you go into the office, there's nobody in the office, right? The office is closed. And actually, we're probably converting it to climate controlled self-storage. There's not going to be anybody in there, right? Everything is done on your phone, or it's done through a call center. So you can, whole operation, right? You call in, tell them where you are, what type of unit you want to get. They give you they basically send the lease to your phone. You sign it on your phone. You send it back to them on email, and then they will send you a gate code. They'll text it to you, and you can open the gate right there, and you can walk to your storage unit and get your unit right there. And we actually provide a lock for them, so they have a lock right away. But not every place is necessarily like that. Some places actually have a person there, so they'll have a person on staff, and that's really kind of a decision that you make as an operator, right? Do you want to have a person there or not? And then I would tell you that you probably want to choose a property management company that's comfortable in what your strategy is, right? So if you have a property, you want to run it all completely unmanned, you probably want a property management company that's comfortable and has experience doing that. If you want to run it with a person in the office and you have office hours and they're good at hiring people and things like that, well, then you probably want to use a property management company that they're very good at that. They have a lot of experience doing that.
Awesome, man. This is so intriguing. It's like shiny object syndrome. I'm like, this sounds pretty sweet. So I guess I'll ask kind of a tough question here is, do you see yourself going back to multifamily, doing both of these asset classes, or are you personally kind of sold on the storage? I mean, maybe it's hard to predict the future, but what do you see as that future for you?
Yeah, that's a great question. And where I feel like is that I'm a deal hunter for those home run deals, right? If I can find a home run deal in multifamily, then I'm interested in getting it done, right? If I can find a home run deal in self-storage, then I'm interested in getting that done. So right now I'm finding a lot more in self-storage than I am in multifamily. I do actually have this one out there that's like this off market. Nobody knows about it. I'm probably the only buyer that they've even talked to. And it's a multifamily project. And I'm still like actively trying to get that one. Still might take a while, but that one is a home run deal. So for me, it's like, is a deal a home run deal? Can I comfortably say that in 3 to 4 years, I'm going to project that I'm going to be able to give 100% of my investors' capital back through a refinance? If I can comfortably say that, and I feel like this is a home run deal, then I'm interested. Right? So that's kind of where I'm at right now.
Awesome. So are you syndicating these deals, or is it like a partnership deal, or what's kind of the structure for you currently for these storage units?
Yeah. So that's a great question as well. So previously 5 different syndications. I also did, one by myself in terms of multifamily, one with JV, and then 5 different syndications. Moving into self-storage, I said, you know what, I don't want to start as big as all these syndications are, right? I don't want to start at $12 million or in that realm of syndicating, because I don't know if my network, all the people that know me, are ready to invest in storage. They know me as I'll invest in multifamily. So I said, well, I'm just going to start off with a very small one. Let's find out if this asset class works the way people say it does on these podcasts, right? If it works on paper the way that it's supposed to. And if it does, then I could grow, right? So I started off with a small one. The first one that closed in January was a smaller deal, and it was just, I think I reached out to 7 people that were either friends and family of mine. 7 either they invested with me before, or they follow me, and they just, people that I know personally outside of real estate. Of those 7, 6 of them said yes in like within 24 hours. So I was like fully funded right away. And so we did the deal. And the next ones after that were also joint ventures. So they're joint venture deals. They're not as big. And so like I when you're doing a JV, for me, you can't do as big of a deal because you're not syndicating from a whole group of people. You're just doing a joint venture with 5, 6 people, 7 people, 10 people, whatever. And then, so these have all been joint ventures. They've all been like under $3 million in terms of the deals. Now, in terms of what I'm looking at next, though, my deal parameters are right now anywhere between $2 to $10 million in terms of what types of deals I'm looking at. $2 to $10 million. Anything from 5 to 10, I'm probably going to syndicate. Anything lower than that, probably in the realm of potentially just joint venture those.
I love it, man. This is cool. It's very cool to like talk about a different asset class because I've been so inundated with multifamily for the last 18 months, so appreciate it. So we'll kind of move to the second part of the show.
Sure.
I focus on mindset. So I have a series of questions. If you're ready, we'll just dive right in.
Let's go for it. I love that idea.
The first question is, what is your morning routine?
So this is a great question for me because, I know, great question in general. I had a very strict, very disciplined morning routine up until 4 months ago when my son was born. So I would say if you asked me that before, like 4 months ago, I would have told you that like, hey, my morning routine is I wake up about 5:30 every morning, and I subscribe to basically the Miracle Morning. I read that book a while ago, and the idea of just meditating, reading, exercising, writing, journaling, all those things that I would do in the morning and before getting started. And then I was like, very disciplined about let's get work done first. Let's not check email. Let's spend a good chunk of time getting work done as fast as possible. So I was doing all that, and I did that for 5 years. So I did that since 2016. We're almost exactly, because it was about March of 2016 that I started. And then my son came, and I just went, I'm not doing any of that. Like, I'm not waking up. I was like, I'm already waking up 3 times at night, and I'm barely getting to sleep. I'm not going to wake up at 5:30 and start to meditate because I'm just going to put myself to sleep. So my morning routine, if you ask me in the last 4 months, has basically been like, wake up, feed baby, go back to sleep. That's my morning routine. So take it kind of where it is. But I would tell you, it's been actually kind of good. A little refreshing to say, like, hey, I can reset a little bit. Like, let me, figure out, like, is this morning routine, was it just something I did, or was it something that was actually productive and actually helped me? Then maybe I can, cut out some of the things that I didn't really need, and then add things that I really, and focus on the things that I really, really liked and could help me propel. So that's where I am right now. It's just kind of evaluating, okay, I'm about to that point where I can start to like get back into the routine. Baby started to sleep a little bit longer, which is great for both mom and dad. And so maybe I can,
great for everybody, man.
yeah, maybe I can start to figure out again, what will be my morning routine. So that's where I am.
Oh, that's cool. So first of all, I have young kids too, so I fully understand. I mean, it's like it disrupts your world in a good way. I mean, you kind of like shift to taking care of someone else. So good on you. I mean, you got to have some grace. I'm going to check back with you in a year and say, it's like an experiment, like, was the morning routine worthwhile? And then we took a reset. What's so cool is, like, I've talked to a few people where COVID kind of did that, like the kids had to stay home, maybe they homeschooled, maybe like work from home, and all the routines kind of went out the window. It's kind of this weird reset. So if you were into the Miracle Morning before that, and then, COVID hit, it was kind of a reset. So it's super cool. I mean, I enjoy kind of hearing all of the responses from all the guests. So I appreciate you being honest.
Mm-hmm. Yeah,
next question would be, what books are you reading, or what books can you recommend?
Yeah. So, I mean, the last books that I was reading were all baby books, right? It was like,
Nice.
hey, how to take care of your baby, right? How to take care of your baby. What is your baby? How to feed your baby? How to get your baby to sleep? So it was all baby books, right? So that was probably, I don't know, the last 9 months or so, all baby books. It was nothing on real estate, nothing on business, nothing like that. So a lot of baby books. Now, if you talk about like what books that I would recommend in the business sense, though, the business sense, probably the Miracle Morning was a big influence on me. Yeah, that was a big influence of kind of changing up my routine. Rich Dad Poor Dad. I know that probably everybody says that too, as well as everybody sort of read Rich Dad Poor Dad, and that was really an eye-opening one for me, and certainly one that I recommend. But there are tons of books. I get inspired by just reading people's kind of autobiographies and like, what they've done, and so in general, those are some of the things that I would end up reading. Right?
I love it. It's funny, like if you look at so we like messaging over Facebook over the last 2 years, maybe, and most of it is basically about fatherhood. So it was interesting to look back about what we've talked about, and it's cool to hear you say, you read books about that, because it was like the most important thing in your world. So yeah. Super cool, man. Kudos to being a good dad, because it does take a lot of energy and work. So very cool that you shifted your mind that way. Next question would be, have you ever had a coach or a mentor? And if so, was it worth it?
Yeah. And I've had coaches and mentors, several different coaches, mentors and everything. Now, was it worth it? I mean, I think so. To me, it's like, okay, I would tell people this. In my experience, I was able to kind of gravitate towards a mentor that, what I wanted was somebody that I could reach out to personally, right? I didn't want their mentor to be so big. Like if I was like, hey, I really like, I like Tony Robbins stuff, right? But if I was like, Tony Robbins is my mentor, well, maybe his teachings are, but the chances of me right now reaching out to Tony Robbins himself and him actually giving me personal advice and me actually being able to do that regularly is not really going to happen right now. So I'm just kind of like, all right, so I don't necessarily want Tony Robbins to be my mentor, right? Because that's, or to join his group for the mentorship. That's just not me. I want somebody that I can kind of interact personally, right? And I like the kind of the smaller settings, right? And so you reach out to other people inside of the group, and I feel like that's better for me. Just kind of like a little bit of smaller groups. And also sometimes when you get attached to those particular mentors, they may not be that big yet, but they may start to take off. And when they start to take off, they may take you with them. And that's kind of what happened with me. It's like I had a mentor, and he started to take off, and I went with him. So so it worked out really well. And then when it comes to like anything, I chose a new asset class, self-storage, right? I didn't necessarily choose a new mentor, but I joined another program. I like learned more about self-storage, right? There's other people that know a lot about it, and you want to learn from them as well. What is their experience? So yeah, I joined the program as well, and just get as much value as you can out of that as well.
Oh, I love it. Awesome. What's the next question would be, what is something you've done in the past that you would not repeat?
Something in the past that I would not repeat. Well, let's see. I bought a couple. Well, one of the houses that I bought. So I kind of didn't talk about one of the houses I bought, probably because nobody really wants to hear. No, I don't really want to talk about. No, it's a house that I bought in Memphis. I bought it in Memphis, and I actually still have it. Now I think about it, I still have this house in Memphis. And I bought it kind of turnkey, sort of, and it didn't really turn out to be as turnkey as possible, as much as it was supposed to be, right? That's not something I'm going to do anymore, so I'm not going to necessarily go into buying like a turnkey single family house, maybe just because I've just kind of moved on from that asset class, at least in this form. I would tell you that I think about every once in a while, like, how can I change it? Maybe I can turn it into like a short-term rental or something like that. That would actually be something that I'd be interested in doing. But I would say that is not something I plan on doing anymore. One of the things too, I realized, and you mentioned it too a little bit before, is that when I look at the overall scope of real estate and buying a property, to me, that there's really three main things. There's the acquisition side of it, right? The buying it, putting it under contract, underwriting it, due diligence, all that stuff, acquisition. The second side is the capital side, right? We're bringing the money, raising the money, how strong is your network, that type of thing, right? There has to be the capital side. The third part is the operations, like, okay, who's going to decide to do what? Like who's going to be the one that makes the decisions on whether we do signage first or we do landscaping, or do we do do we turn the units into, we spend $8,000 or we spend $12,000 on the units, and do we go upgrade from whatever, black appliances to silver, stainless steel, right? All those kind of decisions, right, are on the asset management side of it, right? I will tell you that I am not the best on the asset management side. And I don't really like that side of things. And I don't plan to be on that side anymore. So I've kind of removed myself from that side of things. I'm still involved a little bit, but I don't make major decisions. I don't have, that's not my thing. I'm much better at sort of the capital side and the network side, as well as the acquisition side. And I just say, look, I got my team. They're much better at this. They're much more detail oriented. They like this type of thing. They like getting the property running as best as possible. I'm more like, I want to go hunt more deals. I want to go find the next big deal. I want to go get this. I want to go talk to these people and go get some more deals done, right? And so let them handle what they're good at, and I can focus on something else. So for me, I think that's probably one of the bigger things is like, I'm probably not going to be on the asset management side of things and anymore. And I realized that after a little while.
No, it's so cool. So a couple of things, I mean, to kind of pull from that would be, first of all, this world is just, it's such a team sport. And I kind of get tired of hearing it. You know, it's on the podcast, like a multifamily is a team sport, but it is. And it's super, super true. And it's so practical. What you just said is to like, find your skill, your ability, team up with someone who likes to do the other stuff, you know? But it's absolutely powerful to find your thing that you love and go for it. You know what I mean? So I guess, you know, I'm going to jump in with a different question here before we move on to the next one and be like,
sure.
Do you have any tips for listeners trying to raise more capital? Because it seems like there's a handful of things that are missed a little bit. One, I think asset management, and everyone knows that. You go to a conference, it's not sexy, so no one talks about it. It's like no one ever mentions what happens after the deal is done in those conferences. But also, I think one thing that's missed a little bit would be like capital raising and what it really takes and what it looks like. So do you have any tips for listeners who might be trying their first or second deal for capital raising? Because it seems that that's kind of your superpower.
Yeah, sure. I will tell you this, there's a number of different things. Like you get better at raising capital the more that you do it, right? And so you got to start right away. And you got to and that means you got to start telling people. So first thing is you got to start telling people what you're doing and how excited you are to be doing this, right? And so you got to be getting out there. And I've told people, like, some people are like, I don't really want to tell my friends and family. It's just kind of like, you know, I don't really want them to be involved. And I'm like, you know, that's okay. I mean, you don't have to, but I would tell you that, you know, that's a great place to start. I started there, and I still that's a lot of people that I know is like that want to invest with me are friends and family, because people invest with you because they trust you, right? And so you have to be out there telling them what you're doing, and they have to see, does this guy have enough knowledge? Does this guy have enough experience? Do I trust him as a person to do what he's going to do, what he's saying he's going to do, right? Because when they look at like the investment summary that you may send to them, or a video or something like that, you're looking at it as in, hey, I've been studying real estate for years, and so I know what all these things mean and why these are important. But these numbers and these terms and why this market is great. But they're looking at it as in like, I've never seen this before. It looks cool. I don't know exactly what all these numbers mean, but what about you? Do I trust you, right? Do I particularly trust you? So I have a lot of people now that I know they don't know exactly what is all this on stuff on the investment summary. They're just kind of like, oh, okay, probably you feel like this is a really good deal? I tell them, yeah, it's a great deal. They're like, okay, sounds great. All right, well, I'm in. I'm in. And they're not really worried about, okay, well, what if 16% IRR? What's your exit cap rate? And did you do your sensitivity analysis at 30% vacancy or whatever? They don't ask that kind of question. They're just like, you feel like this is really good, huh? This good market. You're going to go there and visit it. Yeah, you like it, because they actually just trust trust me over the time. Now, the other thing I would tell people is that you got to tell people in all kinds of different circles. So if you know me, I play beach volleyball. Every Saturday, Sunday, I'm out there playing beach volleyball. I love it. It's one of my favorite things to do. It helps me clear my mind and get outside and in the sun. I just, I love doing it. But I tell people at beach volleyball, right? They ask me, what are you doing? Hey, I'm buying real estate and I'm doing this. And for the most part, they don't really care. They're just like, hey, whatever, I don't care. They're more important about what's the water temperature like, because they want to jump in the water later, right? So they don't care. But every once in a while, some people do, and some people are like, hey, I bought something once, and I'm thinking about investing in apartments, or I have some money, or, I'd like to do this. And so I have a bunch of people in the beach volleyball group that are interested in that do invest with me. Right. And it's like, I don't go to beach volleyball to try to find people that I want to raise capital from. Right. It just happens to be that I love playing, and they know who I am, and they've seen me after, for years, and they got interested after a while, and they want to invest. Right. And so you got to tell all kinds of different people, all kinds of different circles as well. And just kind of on a more granular thing, just for your investors or for your listeners. One line that I always use, you'll hear me use it all the time with my investors, is when we're getting down to like, hey, they're interested. So they're like, yeah, I'm interested. Send me your next deal. I'd love to hear more about investing in self-storage. You want to get the dollar amount. Like, what type of dollar amount are they talking about, right? And it's kind of an uncomfortable situation. You go, I don't know. I don't want to ask them how much money they make, or what's their bank account like. So you're kind of like, oh, how do I ask this, right? Because if they're interested in investing $5,000, well, they might not be their investor for you. But if they interested and they have like $500,000, you don't really know, right? Until you kind of ask this. So my sort of word for word is to say, how much are you comfortable investing? Right. And then you just leave it at that. And in whatever they say, you just say, okay, right. You just say, okay, that sounds good. So they might say $25,000. You go, okay, well, maybe it depends on what type of deal I have that maybe you could get in, but maybe not. Maybe you're just not, the right person. And maybe they say, I don't know, I got like $1 million. They're just kind of sitting around. And you just go, sounds good. I'm comfortable. And maybe, how much are you comfortable with? And they're like, I don't know, 250, 150, and you just go, okay. Well, then you got a person that's like probably comfortable at investing 150 or 100 or whatever. You just never know what the answer is, right? But you don't want to, you don't want to blurt out something at that point like 150. You're just 150. You don't want to get crazy like that. But just say, oh yeah, okay. But I think it's an easy way for people to just say, how much are you comfortable investing? Right? I'm not trying to pressure you. I just want to see how much are you comfortable with. And if you're comfortable with 75,000, cool. If you're comfortable with 250, cool. You're just, you're a different type of investors. And then that gives you a sense of they would invest around that much, right? And then you can start to ask them, later on, you might not want to ask them right away, but you start to ask them, are they liquid? How soon could they invest? Like I have some deals coming up. Like, are you able to invest? Like if I bring it up to you next month, and that'll give you an idea of their liquidity, right? They might say, no, I have to 1031 something. I have to sell of the business, and I have to talk to my brother and everything. So you're like, okay, well, they're probably like 6 months out, versus, yeah, it's just sitting in my my Scottrade account or whatever, So, so those are some questions I would ask, just word for word, how much you're comfortable investing. And then if I have a deal that, that comes up within the next, say, month or two, would you be able to invest in that, or would you be interested in something like that? And you'll get an idea of how liquid they are.
Oh man, it's such like practical stuff. So really appreciate that. I mean, I think anyone raising capital, and I've never said this on the podcast before, but I kind of hate that term, raising capital, because it sounds like you're raising money, which in reality is kind of not the case. What you're doing is you're giving the opportunity. I wish there was like a better term, be like, you're finding people to help in their financial journey. So I've always hated that term, but it's the industry norm. So I'm not about to change it now, but I just wanted to put that out there. But the point I'm trying to make was such practical stuff. So I appreciate you sharing. Cool. And then the final, the next question I have would be, what mindset tip can you give someone? I started with this like starting out thing, but let's just say, what mindset tip can you share with our listeners?
I think that, like if you have a growth mindset, a mindset that like, hey, how can I do better? I think that's a significantly important, mindset tip. It's just like, how can I make this better? Right. And what can I do? Like, what can I do? Like take personal accountability to make this better or to change the situation. Right. I kind of just always feel like that's like, I want that to be my mindset. And that's always sort of been sort of my natural mindset is like, hey, a situation happens. It's like, something happens wrong with the property, or the contract's about to fall through, whatever. It's like, okay, well, what can I do? Okay, the contract's about to fall through. So what can I do? Can I get it to them right away? Can I fix it by telling them that I'll take care of this portion? Can I reach out to the seller and and say, hey, how can we negotiate this part that we can't get over with? What can I do to make this thing happen? Right? There's stuff you can do. There's always things that you can do. But if you're a little bit more like, oh man, this always happens to me. Like I always get this close and things fall through. You know, you can kind of take the victim mentality. Or if you're always like, man, I always deal with these people and they never come through. People always just like lying about what they do. Then you're blaming other people, right? And you're never really taking accountability for yourself and like what you can do to change the situation, right? And I would say, you know, that's probably one of my biggest things. It's like, you know, just kind of take accountability of what you can do to change your situation. And if you always have that growth mindset of like, hey, I can do better, I can do something different, or I can bring in somebody, maybe I know somebody that can help me out. I would just think that like you just kind of live in a sort of a better space, right? You make things happen for yourself, and you know, you're not caught up in sort of the negativity of like, I can't get this done, or these people never do it, or this always happens to me, and it's a victim mentality, right?
Oh man, might have been one of my personal favorite responses to that question ever. I mean, it's so good. So I won't even respond. The next and final question, I mean, it's kind of a two-part question, but we'll just start with, what is your definition of success?
Yeah, you know, that's a tough one for me. I don't know, definition of success, just because I don't really necessarily have a specific definition of success. Like, you know, for me, I guess it's you set your goals, right? You set your goals and then you work towards achieving them, right? Now, it doesn't mean you actually achieve all of them, right? You work towards achieving them. Is that a definition of success? If you're happy with where you're at and you're comfortable with where you're at, that's great. I think then that's pretty successful, right? You don't necessarily have to compare yourself. You don't necessarily have to think of a specific number you got to get to. It's like you personally want to do something in your life and you're working towards it and you feel good about where you're at or where you're going, and you feel, you know, and you're happy with that. To me, I feel that's pretty successful, right? And I feel like, you know, that you should be proud of that, right? And it doesn't even have to be a real estate. Like I talk to people and they're like talking about how they want to do something more with stocks and bonds. And I'm like, that's not really me, but if you're happy with that, you're comfortable with that, and that's what you're working towards your goal, and you're close to getting there, that's awesome. You know, feel proud about that. So I can consider that successful, even though that's just not really my realm. So I don't know.
No,
that's kind of a generic answer, but yeah, I would say that's where I feel.
No, I mean, I love this question because everyone has a different response, right? And so there is no definition. I mean, that's kind of the purpose of the question. And I love that response. I mean, I agree 1,000%. It's like, if you're headed in a direction that you're happy with and you're happy with where you are, I mean, that's huge, man. And everyone's path is different. So of course it's not, you know, not everyone can or wants to do real estate. I guess probably everyone could, I suppose, but you know, a lot of people don't want to. The point is, yeah, if you're headed in a direction that you're happy, that's huge. So I love the answer. And then the second part of that is, if someone asks you, why are you specifically successful, you know, versus others, what is your response?
Yeah. And, you know, like for me, it's like, I'm on that journey, right? I'm on that journey. I haven't accomplished all the goals that I've set forth. I'm not there, right? But I'm working towards it. And I would say I'm happily working towards it. And sometimes, you know, you get in more, like right now, I have a lot of momentum in the way things are going. I'm very, very grateful for the momentum that I have. But even when I didn't have as much momentum, it's like, you know, I'm working towards it. I feel good. I like the people that I'm around. I'm learning more. I'm getting better at this. And I just feel like I'm growing in general. And I feel like there's this path ahead of me is kind of the path that I want to be on. And that's kind of where I've been. I've been that way for a couple of years now, right? I haven't hit my, you know, end goal, and I'm nowhere near my end goal necessarily. So I wouldn't say like, hey, it wouldn't be a person that would say I'm not successful until I hit my end goal, or I am successful because I hit these specific goals. It's like, well, that's good. You know, and these are goals that I did hit, but I still have a lot more to go. But I feel very good about the path that I'm on. I feel very good about bringing others on that path as well. And I feel like, you know, I'm just in general kind of happy about the way things are heading. And so that's what I would say, that's what makes me successful. And so, yeah, that's kind of where I am.
Oh, I love it. So good, man. So a couple of things, I guess I'll give you a shout out. So speaking of your momentum, I mean, you've done 3 deals 1 year, which is incredible. So kudos. I wanted to
Actually,
shout that
four,
out.
just so you know, four in 1
Four.
year. If you
Oh
were to say 1
man,
year,
sorry,
3 in 1
I
month,
shorted
3 in,
you.
3 in 1 month. Yeah, four in a year.
Oh, three. Okay. Holy cow. All right. Let's backtrack. 3 in 1 month. That's insane. So I had that backwards. Man, that's super cool. So congrats to you, especially the newborn. It's incredible. So yeah, you do have some serious momentum. So shout out and thanks for the correction.
Thank you. Yeah, thank you. No, all good. All good.
Yeah. And then, we met through Multifamily Masters. So I guess now would be a good time to pitch it. If you don't mind, feel free to tell us what it is and what it's about.
Sure.
I met you through that. I really enjoy it.
Yeah, absolutely. Absolutely. So appreciate that. So Multifamily Masters is a group that I started probably close to 3 years ago now. I started like 2018, I believe, 2018. In December of 2018, it was basically a group that around here in LA, there was a bunch of meetups about real estate, but there wasn't anyone the one that I wanted to go to, right? There was kind of general real estate. There was wholesaling or fixing and flipping, and there was a little bit of multifamily, but it was more like buying duplexes and triplexes around LA. And I was like, that's not me. I'm buying properties out of state, and they're all multifamily. So I don't know any group that does that. So I started this group meetup, and the first group was like 8 of us sitting around a table in a hotel lobby talking about real estate and multifamily and buying out of state. And from that first group of 8 people, it started to grow significantly, like faster and faster and faster. And then, within I don't know, within 6 months, I had 3 chapters in LA. And then with a year later, so about a total of like a year and a half, I had 9 chapters, all in Southern California. And then if you fast forward that to about 2 total years, and about 2 total years, we had about 50 groups, right? So 50 chapters all throughout the United States, and even some international as well. And so that's kind of where we are now, is that like, hey, this group has turned out to be sort of an international group, focused on community, focused on networking, focused on education, and really helping people. There's been tons of partnerships. I've met my business partner through my own meetup. Several other people have met their business partners through their local chapters meetups. And so, people can go to multifamilymasters.com, or you can go to our Facebook group, which is, Facebook/groups/multifamily master or /MF masters. And those are a great places to go, or we're also on meetup.com. You can sign up there as well. We are putting together an event. So we're putting together a large event, and it's called Multifamily Con. So if you go to multifamilycon.com, it's an actually in-person event. We're putting it on in November 13th and 14th. It's in Orlando, Florida, at the Orlando Hilton. And it's a 2-day event, putting together a bunch of people, a bunch of great speakers, a bunch of great panels, all kinds of different things to learn about multifamily and networking, and to learn from industry experts as well. So we're bringing in some industry experts as well. And it's all really just about like, hey, let's all get together in person and start to meet each other, form these relationships, and help each other out to acquire more properties, acquire other type of properties. So super excited about it, and appreciate you giving me the time to let people know about it as well.
No doubt. Yeah. And I'll actually be speaking at that event. So this is a personal note that I'll be there, of course. And I think we talked about that, but I'm excited to be there, man. I'm excited to check it out. And I've really enjoyed the group. So of course, give you the time to do that. So the final thing, Powell, is how can people reach you? I mean, where can people connect and learn more about what you're doing?
Sure. I would say the easiest and probably the fastest way is if you reach out to me on Facebook. So just, add me as a friend, and, send me a message on Facebook. That's a great place. There's other things. If you go to multifamilymasters.com, our website, you can see there's my contact information there as well. I also have like radiant storage, so our self-storage facility. So, you can go to radiantstorage.com, things up there. Those are typically the things that I would say, but I would say the best way personally is really just go to Facebook, and add me as a friend, and then send a message to me. Happy to reach out and talk to people as well and discuss any particular topics. I know recently I've been kind of putting together some live streams. So I do a live stream, trying to do about once a week. I don't know, I'm just starting right now, so we'll see, but once a week. And I talk about self-storage investing and different types of things that I've gone through in my journey of self-storage investing, and give people a chance to get on the inside and see what it's like to be on the inside, and also give them some advice, and they can ask me questions and I can give them some advice or talk to them about how I've done it in the past, and hopefully help them out in getting their own properties.
Oh, I love it, man. It's so cool. I've seen a couple of them, and it's awesome. I mean, you're basically providing value, and people can learn from your, maybe mistakes, maybe your successes, but yeah, I love it. So Powell, thank you so much for your time, man. Thanks for being here. Really appreciate being on the show.
Thank you, Eric. Really appreciate it. I had a great time. Thank you.
Thank you for listening to this episode of the Real Estate Mindset Podcast. If you've enjoyed the content today, please follow this show wherever you listen to podcasts. And don't forget to head over to wildoakcapital.com for more information or to connect with Eric directly. Please take a moment to leave a review or tell a friend about what you've listened to today. We hope you'll tune in again soon.